Hey everyone, and welcome. If you're gearing up for your 10th standard board exams, you are in the exact right place. Today, we're totally crushing Chapter 31 of your economics syllabus. And to make this super easy to digest, I want you to just think of the country's finances like managing a giant national wallet. We're going to lock in these high-weightage concepts right now so you can walk into that exam hall feeling absolutely unstoppable. Let's get into it.
So imagine trying to balance the income and expenses, not just for a family of 4, but for over 1 billion people. Honestly, it's a massive, high-stakes puzzle. How does a government actually decide what to spend on schools, roads, or defense? And seriously, where on earth do they get the money to pay for the whole shebang?
Well, here is our game plan for the next few minutes. We're covering exactly what the examiners want to see: the nation's wallet, money out, money in, tax traps, and finally, the deficit gap.
Okay, starting with Section 1, the nation's wallet, its meaning and importance.
Right, so what exactly is public finance? Basically, it's the study of how the government manages its income, its expenditure, and its debts just to keep the country running. Now, listen up, because here is an examiner's absolute favorite. The classic 5 to 6 sentence question usually asks for the fundamental differences between private and public finance. And the really cool part is the core difference in how the math actually works. Think about private finance, like in your own family. We calculate our income beforehand, right? And then we spend accordingly. You have 100 rupees, you only spend 100 rupees. But in public finance, the government does the exact opposite. They calculate their expenditure first. They figure out what the country actually needs, and then they adjust their income to match that requirement. Oh, and also, personal transactions are kept confidential, but public finances, those are discussed openly in the legislative houses. Make sure you lock that in.
Now, if you get hit with a 4-mark question on why public finance actually matters, you're going to want to write down these punchy points. The government uses fiscal policy to basically ensure everyone lives comfortably. They use it to establish economic progress, to equitably distribute the country's natural wealth, to eradicate poverty and unemployment, and to regulate commodity prices to prevent financial disasters. For a developing country like India, it's literally the ultimate tool for establishing financial stability.
Moving right along to Section 2, money out, or public expenditure.
Let's open up this giant national wallet and see where the cash actually goes. Imagine a flowchart, kind of like a giant tree. We're going to do a quick mental walkthrough here. At the very top, we have total public expenditure, and that splits into 2 massive branches. Over on the left, we've got revenue expenditure. That's for your daily running costs. And on the right, we have capital expenditure, which is all about creating brand new assets. Let's break those down a bit more.
To keep it incredibly simple for the exam, revenue expenditure is the money spent from revenue income on things like financial and social services, defense, and administration. Just think of it like paying a teacher's monthly salary. It keeps things running, but it doesn't build anything new. On the flip side, capital expenditure is the money spent on things like agriculture, industry, transport, and irrigation projects. It's the massive long-term investment. It's building the actual school itself.
So the really crucial point here is that under both of these main branches, we have planned and non-planned expenditure. Planned expenditure is money spent directly on developmental activities under various plans, so building a new hospital or funding science and technology. Non-planned expenditure, though, covers the absolute necessities that aren't strictly developmental. Think civil administration, defense spending, and, here's a really big one, paying interest on previous loans.
Check out these real numbers from the central government's estimated expenditure back in 2013-14. A massive 21% goes strictly to central planned developmental activities. But get this, look right next to it. 18% of the entire budget is eaten up just paying interest on old loans. Add in 10% for defense and 12% for subsidies, and you start to see just how tightly the government has to manage this wallet.
All right, Section 3, money in, also known as public revenue.
Since the government spends so much money building infrastructure, paying salaries, and defending the borders, they obviously have to fill the wallet back up. So here is our second mental map, and you absolutely need to memorize the structure. Public revenue splits right down the middle. On one side, we have revenue receipts. This is your actual, real income from taxes and non-tax sources. On the other side, we have capital receipts. This revenue is intended to create new assets, but it mainly comes from taking on internal and external loans or sometimes withdrawing investments.
Now, examiners love asking about non-tax revenue sources. To memorize this list effortlessly, just use this simple acronym, RRPPTM. I'll say that again, RRPPTM. That stands for RBI profits, railways, post and telecom, public sector industries, and mints, plus your everyday fees and penalties.
Seriously, if you just jot down RRPPTM on your scratch paper when you sit down, you are practically guaranteed full marks on this question.
Next up, Section 4, Taxes, Direct versus Indirect.
Let's dive into the absolute biggest source of the government's income, taxes. Now, a tax is just money paid by citizens without any expectation of a direct return. And the government operates this on the principle of progressive taxation. That basically means higher rates for high-income groups and lower rates for low-income groups. In fact, the poor are entirely exempted from income tax. Now, warning, this is a huge common student mistake trap. When asked for the difference between direct and indirect taxes, students always get tangled up. Just remember the concept of burden transfer. Direct tax means you pay it directly from your own income. The burden cannot be transferred to anyone else. Indirect tax, however, means the burden is transferred to the consumer. The government taxes the manufacturer, who passes it to the trader, who passes it right to you when you buy a packet of chips.
Okay, listen closely, because identifying these correctly is a super common test question. Direct taxes include personal income tax, corporate tax, wealth tax, and stamp duty. Indirect taxes include things like central excise duty, import-export taxes, and service tax. Guys, in the 2020 board exam, identifying corporate tax as a direct tax was an exact multiple-choice question, so lock these examples into your brain right now. Corporate tax is a direct tax.
Looking again at that 2013-14 data, notice how incredibly important corporate tax is. It alone brought in 21% of the government's entire estimated revenue. Personal income tax brought in about 12%. But take a look at the biggest slice of the pie there. 27% came from debt and other liabilities, which tells us the government is borrowing quite a bit to fund its growth.
And finally, Section 5, Closing the Gap, talking about deficits.
So what actually happens when the government's money out is greater than its money in? Like, what if they plan more expenditure than they actually have revenue for? Well, this is called deficit financing. Now, you might immediately think, wow, going into debt is really bad. But for a developing country like India, presenting a deficit budget is actually a deliberate, positive strategy. It's designed to force rapid economic progress. To fill that gap, the government raises loans from the RBI, withdraws cash reserves, or gets internal and external loans so they can keep building critical, long-term infrastructure.
And this right here is a guaranteed one-mark question format. The examiner will definitely ask you to express fiscal deficit as a formula. Memorize this exactly. Fiscal deficit equals revenue receipts plus non-debt capital receipts minus total expenditure. Essentially, this formula just calculates the actual total burden of loans the government has to take from outside sources to survive the year.
All right, I want to leave you with this final kind of mind-bending thought as you go back to your revisions. We learned earlier that when an individual saves money, it builds their prosperity. But when a government saves money, a country's growth is actually stunted. Think about that massive difference. The nation's wallet isn't meant to be hoarded away under a mattress. It's meant to be spent, invested, and utilized to build your future and drive the entire economy forward. Keep that core concept in your head. Remember your formulas, avoid those tricky tax traps, and you are absolutely going to ace Chapter 31. You've got this.